Think of a modern hedge fund, and you likely picture high-risk bets, billionaire managers, and massive leverage aggressively spiking and crashing alongside global markets. These vehicles operate behind strict exclusivity barriers. They are legally structured as unregulated collective investment schemes. To even walk through the door, you typically need a minimum investment of $100,000 to over $1 million. Once inside, your money is locked in for months, and the fund managers take a hefty cut, often 20% of the profits plus an annual fee. But looking back to their origins in the 1950s reveals a strange paradox. The very first hedge funds were engineered to do the exact opposite of making wild speculative bets. They were designed to completely eliminate market risk. The strategy was built around a concept called absolute return. The literal definition of hedging in finance is protecting your capital against a broader crash. The goal was to generate steady, positive returns, regardless of whether the overall market went up or down. So how exactly did a financial tool engineered for ultimate mathematical safety evolve into a multi-billion-dollar speculative black box? The answer lies in their structure. Because hedge funds are closed off to everyday retail investors, they are exempt from standard trading regulations. They have complete flexibility to invest in almost whatever they want. This freedom grants them access to unconstrained financial tools. They can use complex derivatives. They can short sell, meaning they bet on a stock's decline. And they can use gearing, borrowing heavy amounts of capital to amplify their potential returns. At the most conservative end of the hedge fund spectrum, managers use these tools for non-directional strategies. The objective here is to insulate the portfolio so thoroughly that it generates a stable return even if the broader economy is flatlining or collapsing. This diagram illustrates a market-neutral approach, often called pairs trading. A fund might take a long position on a major oil company like BP, expecting it to rise, while simultaneously shorting another oil company like Shell. By balancing the two against each other, the fund isolates the specific performance of those companies and cancels out the risk of the entire energy sector tanking. Expanding on that mathematical approach, we find statistical arbitrage, or StatArb. Here, algorithmic black box models scan the market for assets that have strayed far from their historical averages. The system places trades based on the high probability that the asset's price will eventually revert back to the mean. These non-directional strategies represent the true hedge. They rely on dense mathematics to perfectly insulate wealthy clients from the everyday volatility that wipes out retail investors during a crash. Moving up the risk spectrum, some abandon pure math and start hunting for corporate chaos. These are known as event-driven strategies. Take merger arbitrage. When a corporate takeover is announced, there is often a temporary discrepancy between the current stock price and the final deal price. Hedge funds step in to extract profit from that exact spread, buying the target company and selling the acquirer before the deal closes. Then there is the distressed security strategy. Funds actively seek out failing companies struggling to meet their financial obligations. By buying up the cheap debt of these distressed firms, the fund positions itself to profit from the bankruptcy and restructuring process. But the extreme high-risk tier abandons the concept of hedging entirely. These are directional strategies, where managers make massive, uninsulated market bets. The ultimate directional gamble is global macro trading. Instead of analyzing single companies, these funds look for large-scale vulnerabilities in global capital markets, placing highly leveraged bets on the fate of entire economies, interest rates, and foreign currencies. No one executed this scale of trading quite like billionaire George Soros. Soros recognized a severe macroeconomic vulnerability in the British economy in 1992. Seeing that the country's exchange rate mechanism was artificially propping up its currency, his fund took a massive, concentrated short position against the British pound. Shorting a national currency at this scale is a direct financial attack against a central bank. Soros's position eventually broke the Bank of England, forcing it to withdraw from the European exchange rate mechanism. The pursuit of absolute return began as a method to protect capital. But by weaponizing leverage and operating without regulatory constraints, the industry scaled up from safe mathematical hedges into a vehicle capable of world-shaking speculation. In the modern market, a hedge fund serves as a catch-all wrapper for the highest degree of financial, mathematical, and regulatory flexibility. This image captures the reality for standard retail investors. They buy stocks or mutual funds and are strapped into standard market exposure. When the broad market moves down, their life savings fall right along with it. They ride the roller coaster. Hedge funds require an immense toll to bypass that ride. You have to meet the massive capital barriers to entry, accept the lock-in periods, and pay exorbitant performance fees. In exchange, the ultra-wealthy secure a mechanism designed to engineer profit out of thin air. Whether they are balancing algorithmic pairs, trading the debt of bankrupt corporations, or shorting sovereign currencies, their returns are utterly detached from the health of the global economy. A hedge fund is the ultimate expression of financial privilege, the ability to buy your way off the market's ride entirely.